Welcome back to yet another session on the Learning Simplified series. This time we have supply chain finance, a very exciting topic and which has been getting a lot of traction these days. So this is a two-part video. The first part will be what is SCF all about, how does it work? So in the next session, we'll learn more about the underlying IT infrastructure required for SCF. So supply chain finance, I mean, there are two things. One is factoring and the other one is reverse factoring. Reverse factoring is what is better known as supply chain finance, while factoring is seller centric. The reverse factoring is buyer centric. And in the coming slides, we will try to understand why it's buyer centric, why this is seller centric, why it is called supply chain. So all those will get answered in the subsequent slides. So consider this scenario, right? So you have a big corporate, Tata Motors, big automobile company in India, and they will have a lot of suppliers, seat suppliers, tires, gearbox, mirrors, and hundreds of suppliers, small and big. Most of them will be small and medium enterprises or even micro enterprises. And they will be supplying their goods to Tata Motors and then they will send their invoice. So let's assume that the seat manufacturer here sends an invoice of 100,000 to Tata Motors. Now, Tata Motors is a big company, and most companies, big or small, they don't pay up immediately. Tata Motors may say that, okay, fine, thanks for the invoice, you will get your 100K after 60 days. Now, the seat manufacturer is a small enterprise. He needs working capital funds urgently. He has to pay his staff, electricity bills, and also to his raw material suppliers down the chain. So, what do we do? This is a scenario. So, that's where factoring comes into play here. Now, we need a bank or a financial institution in the picture because they are going to help fund this transaction. So, what the seat manufacturer will do is that they will send this invoice to the bank. The bank will check the invoice, validate it with Tata Motors, check the genuineness of it, and then if satisfied, the bank will then say, okay, here's your money, but I'll give you 90K. The 10K is the bank's processing charge and interest for this transaction because he's taking a risk, a credit risk, right? And of course, there's a lot of infrastructure the bank is using to facilitate this deal. So 10K is the income for the bank for this transaction. The supplier is happy because he got his funds immediately to pay his staff and his suppliers. So what happens is the Tata Motors would give back the 100K to the bank after 60 days. So that's how this factoring process work. So you know that this is initiated by the seller. So that's why it's known as a seller centric. Now, why this way? The supplier could have directly gone to a bank and asked for a loan, right? An overdraft or a working capital loan. But then the bank would ask hundreds of questions to the small enterprises. They will ask, okay, what's your credit standing? What is the collateral you have? I'll not give you this. The interest rate should be high. But this factoring process works very well because the bank knows that Tata Motors, being a good company, reputed company, they are sure to pay me back after 60 days. So that's the guarantee which the bank has. Now, to be noted here that there are two kinds of flavors here. One is with recourse and what without recourse. What does it mean with recourse? It means that after 60 days, if for some reason Tata Motors doesn't pay due to whatever reasons, the bank can take recourse in the supplier. That means the bank can demand that money from the supplier. Without recourse means the bank will not come to the seat manufacturer at all. He will follow up only with Tata Motors, and if Tata Motors doesn't pay, that's it. The bank would make that as an NPA and then probably write it off. So obviously, the one with recourse, without recourse, is going to be a costlier one for the supplier. The bank may charge more processing fees, and instead of giving 90K, might give 85K or 80K. So this is about the factoring process. Reverse factoring, as you would have guessed it, the reverse factoring, the initiation is done by the buyer, the Tata Motors in this case. So the Tata Motors, one receiving the invoice, they will send the invoice to the bank and tell them, this is the invoice, please pay this 100K to the seat manufacturer. The bank will happily pay because Tata Motors is a good customers of theirs, and they will, and in this case, the seat manufacturer gets the complete 100K. Tata Motors gives 110k, the 10k for processing charge and interest after 60 days here, right? So this is reverse factoring, and because the buyer has initiated this, this is known as reverse buyer centric. Now, you would ask, why would Tata Motors initiate this? It's for the supplier's benefit. What is Tata Motors benefit? Number one is that there's improved supplier relationships, right? Because um, you will maintain a very good relationship with the suppliers. Suppliers are very happy with this arrangement, right? And the next one is that the supplier ecosystem would be in good health. As a big corporate, it is in your best interest that all your suppliers are in good health, because if any one of the supplier goes down, your assembly line is disrupted, and that's a much bigger loss, much bigger than this 10k interest which Tata Motors is paying. And it's less admin work for the buyer's finance team. Tata Motors has to deal only with the bank for payment, while the bank takes care of the payments to all the individual suppliers. So with this, you would have got an idea what is factoring, what is reverse factoring, why it is known as supply chain finance, because you are financing the supply chain of the corporate. What is buyer centric, what is seller centric. Now, with this background, you will be able to better appreciate what RXIL, which was a joint venture of SIDBI and NSE, they did when they introduced in 2016 the TReDS platform, Trade Receivable Discounting System. There's a very nice video which I have posted on the description box. Have a look. Now, with this background of factoring and reverse factoring, you'll be better appreciate the TReDS platform which was introduced. The whole factoring and the reverse factoring is regulated by the Reserve Bank, which is the Central Bank of India. And this was, I think, in the year 2011 when this law was introduced to regulate this. So in the next part, we're going to see what is the digital infrastructure required for a bank to get this kind of arrangement done, because this is much more than a loan or a finance. There's a lot of invoicing to be taken care of. There's a lot of reconciliation to be taken care of. So that will be seen in the next part. So thanks for being with us. Have a nice day. Thank you.